Good evening, everyone. This is George at Learn to Trade. We're going to get started with today's tutorial on foreign exchange trading and CFDs. Now, if you recall, a couple of weeks back, we had done a tutorial on futures and using the appropriate platform for trading futures, which was multi-charts. Tonight, what we're going to be doing is we're going to go through what foreign exchange is. We're going to talk about CFDs, which are similar to futures, but without certain responsibilities, which we're going to look at a little bit closer. It makes it easier for a beginner to trade, for example, the S&P and all the other indexes as CFDs as opposed to futures, or trading oil and gold as a CFD as opposed to futures, so that you're not responsible for the product itself when the contracts expire. And CFDs makes it a lot easier because it's called automatic rollover. It automatically rolls over to the next contract as opposed to being responsible for the expiry of the contract in the futures market and taking possession of the product or being responsible to deliver the product. So a lot more popularity has been gained in trading indexes, currencies, oil, gold, and other products like wheats and corns and soybeans and some of the soft markets like coffee and sugar and cocoa and so on as CFDs. And more people are starting to trade them simply because they're no longer responsible for the physical product itself on the expiry date of the contract like they are in the futures market. So that's what we're going to look at tonight, is how do we actually trade other products similar to the futures market without having all those responsibilities. So let's get started with understanding a bit about Forex. So foreign exchange, I'm going to kind of give you a bit of a rundown. Foreign exchange is exactly what the word is telling you. It's one currency, what is it worth in another currency. So for example, let's say I wanted to look at US dollars versus Canadian. If I wanted to be a buyer of US dollars using my Canadian dollars, you could go to the bank and the bank would give you a quote. And that quote is referred to as the asking price. So you looking to buy the US using your Canadian dollars, you want to be a buyer of the US using your Canadian, the bank says, okay, here's our asking price. And if you go over to the software, which is called MetaTrader 4, this is the one we're going to be using, and I pull up the US Canadian, so US Canadian, I'm just going to pull this little arrow down. This is your buy price. It says 1.33205. So the asking price is 1.33205. Basically, the bank says, here's the quote. This is what we're asking. So if you wanted to buy, for example, $10,000 of US dollars using your Canadian, the bank is basically saying you need to give us $13,320.50 in order to buy your 10,000 US. Okay, so that's basically what they're asking for on that quote. Now, when you look at this quote, this last decimal point right here, this is a fraction. Most companies in the foreign exchange market only give you 4 decimal quote when you're trading on their software, but the software we use gives you that 5th decimal. This is a fraction. What's important is the second last decimal point. This is referred to as a pip. So if this changes from 0 to 1 to 2 to 3 or the other way, it's plus or minus so many pips. So this is important to know that the second last decimal point is referred to as a pip. Okay, now let's say that you change your mind and you don't want this money anymore. You want to take your 10,000 US and you want to sell it back to the bank so that you can receive Canadian. The bank says, no problem. You want to be the seller of your US dollars because you want Canadian. They give you the quote. This is referred to as the bid price. And if you go back to that little screen, you'll see that they'll give you 1.33169. Okay, so come back here. They give you the quote 1.3316. I'll use 5 here just to keep it simple. Okay, instead of 9. So notice that they give you the bid price. So yep, no problem. You want to sell your $10,000 back to us? We're prepared to give you $13,316.50. Now, obviously, in the bank, that's not exactly the case, because in the bank, they're going to charge you a lot more than that. But for the purpose of trading Forex, you can see the difference between the buying price and the selling price. In this case here, the quote says 1.33205 to 1.33165. The difference between the asking price and the bid price is referred to as the spread. In this case, it's 4 pips. There's the spread between the buy price and the sell price. That's the cost that you incur between buying and selling that $10,000 position. 4 pips. How much is it that? How much does that reflect in actual dollars? From 620 to 16 is $4. So basically, what they're telling you is that 1 pip equals $1 movement. $1 per pip is the cost to transact this particular trade. A $10,000 position is referred to as a mini lot in the Forex language, and you execute your trade at 0.1. So if I wanted to transact a buy or a sell, and I wanted to buy or sell $10,000 of US versus Canadian, my execution would be 0.1 on my execution platform. So if I go back to the chart, you'll see in here, I would change this to 0.1. And that says I'm looking to buy, if I wanted to be a buyer, I'm looking to buy a $10,000 contract. If I'm looking to be a seller, I'm looking to sell a $10,000 contract. Okay? And each pip, which is your second last decimal point, see, it's just the last decimal point is in small numbers. Second last decimal point, this is a 1 pip. These are changing by 1 pip increments. Okay? And that's basically your mini lot. You're trading a $10,000 position, whether you want to be a buyer or a seller, and your cost is $4 because the spread is 4 pips between the buy and the sell. Okay? All currencies that we're trading will give you 5 decimal point quotations, except for anything to do with the Japanese yen. We'll give you 3 decimals. So if I go back to my chart and I wanted to look at a currency against the Japanese yen, let's find one here. There's the euro versus Japanese yen. You'll notice that the quote is 3 decimals right in here. 115.955 to be a buyer, 115.919 to be a seller. You can see that clearly here as well on that little box, the little dot. So this is a 3 decimal point quote. Anything to do with Japanese yen is 3 decimals. And again, it's the second last decimal that is the one that's relevantly called a pip. Okay? So the cost that we incur when we're trading foreign exchange, the cost we incur is equal to the spread of the currency pair we're trading. This is the cost we incur. There are no commission charges. With most companies, the only cost you incur is the spread. So different contract sizes that you're going to find. A standard contract, standard lot as we refer to it, is a $100,000 position. And you execute your trade as 1.0. A mini lot, which is the example I just did on the US Canadian, is a $10,000 position, which you execute as 0.10. And then there's what we call micro lot, which is a $1,000 position, and you execute the trade as 0.01. So let's take a look at the pip values. 1 pip on a standard lot is $10. On a mini lot, it's $1. On a micro lot, it's 10 cents. Now this is an approximate number. Every currency pair will be different. So this, for example, would be your US Canadian. It could also be your Euro US. It could be your Australian US. but not necessarily the Euro Japanese yen or the US Japanese yen. It could be different. So we use an approximate pip value of $10 for a standard, $1 for a mini, and 10 cents for a micro lot. So some of them will be a little bit higher, some will be a little bit lower. Okay, now when you're executing your trade, obviously you're combining the various execution entry points that you're using. So for example, if I wanted to execute a trade, $54,000 transaction, my trade would be 5 minis, so it'd be 0.5, and 4 micros, which is 0.54. That reflects a $54,000 transaction. If I wanted to do a $127,000 transaction, I would have 1 would be for my 100,000, dot, 2 for my 20,000, 7 for my 7 micro lots. So there's my $127,000 execution. Okay, so you're using these entry points to identify the size of the position that you're looking to trade. Remember, 1 pip, give or take, plus or minus $10 on a standard, $1 on a mini, 10 cents on a micro. Now, when we're trading the various products, the various currencies, we need to have a margin account. It's basically a margin account is a trading account. And in this margin account, we are allowed to use what we call leveraging. Okay, so depending on where you open up your account will depend on how much leveraging you get. So if you open up in Canada or the US, the most leveraging you're going to get is 50 to 1, which means that if you wanted to transact, let's say, a $100,000 trade, you would need approximately $2,000 security deposit to secure your position, and then obviously you're going to need more money for liquidity on the position, so that when the position's moving in your favor or maybe even goes against you, that you have sufficient amount of money to be able to sustain drawdowns, as we call it, against your position. Now, in Canada, one of the reasons you might open up an account in Canada is because Canada is fully protected. Your money is fully protected. Not in the States. We're talking about Canada right now. So fully protected. What does that mean? That Canada, in order for a company to do business in Canada, they need to be IROC members, and they also have to be members of the CIPF, Canadian Investors Protection Fund. So in the event that the brokerage firm goes bankrupt, you as a Canadian have full protection on your capital. There are companies that promote their services in Canada, but are not members of IROC and not members of CIPF, in which case your money is not protected. Just be aware of that. The companies that are members of IROC or CIPF, it's written right on their websites. Okay, so somebody that's opening up a large account, like if you're opening up, $5, $10, $15, $20,000 trading account, I would suggest that you find a broker that is fully licensed in Canada. There are companies like Owanda that is fully licensed in Canada, Forex.com, fully licensed in Canada, Gain Capital, fully licensed in Canada. So try to find companies that are fully licensed in Canada, especially if you're looking to open up a large account, because you don't want to open up a large account outside of Canada, because regardless of whether the company tells you your money's protected or not, just take my word for it, your money is not protected when you're outside of Canada. So you want to make sure that if you're opening up a sizable trading account to trade foreign exchange, you stay with a Canadian broker. However, if you're opening up a small account, let's say you're opening up a $3,000 trading account, and you want to have a competitive advantage with someone that has a large account, then you need to go to a company that offers lots of leveraging, high amounts. And the only way you're going to get high leveraging is if you go to Europe. And in Europe, you can find companies that will leverage your money 400 to 1, which means you want to trade a $100,000 position to compete fairly with somebody that's got a $20,000 account. You go outside of Canada, no protection on your money. Just remember that, no protection. So try to find a company that's been around for a long time, 400 to 1 means that all you need is a $250 deposit to secure that position. And with a $3,000 account, you've got plenty of staying power, you've got plenty of liquidity, and you can also trade other positions as well because you have enough sufficient amount of capital. You have a large amount of leveraging. So it gives you a competitive advantage because someone with a $3,000 account at 400 to 1 can control $1.2 million of positions. That's what that means, which means you're competing heavily against someone that is actually needs a $24,000 account in Canada to be able to control the same $1.2 million worth of positions. So it's important that if you open up a small account, you can give yourself a competitive advantage if you just increase your leveraging, go outside of Canada. But keep in mind that your money is not protected. No protection. Doesn't matter what they tell you. Just take my word for it. Your money is not protected. So find a company that's been around for a long time that you don't have to worry about it. Now, what products are we trading? We're going to trade major currency pairs. Always look for the majors. Forget the minors. Major currency pairs would be US dollar, Canadian dollar, euro, British pound, Swiss franc, Japanese yen, Australian dollar, New Zealand dollar. These are your major currency pairs. Any combination of these is reflecting a major currency pair. And the spreads on your major currency pairs are far tighter, smaller than they are when you're looking at minor currency pairs. So stay away from Mexican pesos and Brazilian reals and Russian rubles and Slovenian dollars and Hong Kong dollars and Hungarian forint and so on. Stick with anything to do with these currencies right here. When you're looking at trading currencies, you're always going to have a pair, one compared to another. So we might see something like Euro US. You might see something like US Canadian, British pound US. This is all to do with the US dollar right now. US Swiss franc, US Japanese yen. So you'll notice that all I'm doing right now is I'm just posting all the pairs that have to do with the US dollar. But you can also create all the pairs that reflect the euro. So you could have Euro Canadian, Euro British pound, Euro Swiss franc, Euro Japanese yen, Euro Australian, Euro New Zealand. You could have British pound Canadian, British pound euro, British pound Swiss franc, British pound Japanese, and so on. You could have Canadian Swiss franc, Canadian Japanese yen, Australian Canadian. I mean, there's all sorts of currency pairs that you can create with these 8 right here. So right now, notice I've got all the ones that have to do with the US dollar. The reason I'm showing you all the ones compared to the US dollar, because the US dollar is referred to as the reserve currency of the world, and this is the most popular currency pairs that are traded. So if you wanted to stick with the high volumes, the ones that are the most popular, they would be the ones compared to the US dollar. But that doesn't mean you can't trade other currency pairs. Okay, so if you're looking at trading these currencies, you'll notice that US Canadian, this pair right here, they're both North American currencies. So their popularity is far more in the mornings, 7 a.m. till 4 p.m. They're more popular during this time. Euro US, you've got popularity 7 a.m. to 4 p.m. But you also have the euro, which is the US, which is Europe, and you would have popularity from 2 a.m. till about 11 a.m. So notice that you've got a lot of overlapping times when you're trading North American and Euro currencies, including all these ones as well. And then you have your US Japanese yen, Australian, New Zealand. These are more Asian time zone. You've got your North American time zone, and then you would have your Asian time zone, which is about 13 hours difference than the US. So anything around 8 p.m. would reflect these currencies. So when's the best time to trade your currencies? Ideal time frame is when you have the most overlapping markets. So you have the Asian time zone wakes up first, European time zone wakes up next, North American time zone is the last one. So I would say any time in here, in this area here, would be your best time to be trading. So I'm going to say midnight to noon, you're going to have lots of overlapping markets. So lots of overlapping traders, lots of volumes. It doesn't mean you can't trade before midnight or after in the afternoon, but my suggestion is try to find something in here, more and more volatility. If you're going to trade before midnight because you just can't stay past midnight, then don't trade before 10 p.m. and don't trade after 3 p.m. Not a whole lot happening after those times. Okay? And most importantly, do not trade from 4 p.m. to 8 p.m. Do not trade during this time because most products are going to close down during this period. Not necessarily the currencies, but if you're trading other products like indexes, current indexes, oil and gold, and maybe some of your other favorite products like grain products and soft market products, they're not going to be open between those hours. So be careful. Okay? And there's not a whole lot of volumes trading in this time either. So try to stay deeper in the night. Any questions so far? I have a question. What's the difference between a futures currency contract and a foreign exchange currency contract? Good question. Forex is referred to as the spot price, also referred to as the cash price. In other words, today's price. So when you go and you have, let's say, your US dollar versus Canadian, you want to buy your US dollars versus the Canadian, you're going today into the bank and you're getting the cash price. And let's say that's $100. The future price would be, if I take that $100 and I say, okay, I'm going to put it in the bank at 5% interest for 12 months, it means that $100 in the future, 1 year from now, is going to be worth $105. So the future takes into account variables that might have an impact on the products that you're currently trading today. That's the difference between today's price and the future price. So when you're trading futures, you're trading the future value based on the variables that are included of the current spot price or today's cash price. Okay, hope that answers your question. So trading the foreign exchange market currently is referred to as CFDs, because if you were trading the futures market on the Canadian dollar or the Australian dollar or the Japanese yen, when the contract would expire, you would be automatically responsible for that contract. Either you would be buying the currency that you were trading or you would be selling the currency. So the futures market would create the responsibility that you either accept or deliver the product. Whereas in the CFD market, when we're trading Forex, we are not responsible for the contract expiring. What ends up happening is every day there's what we call an adjustment that takes place called the swap rate. And every day there will be a charge if you hold a position past 5 p.m. So if you're going to hold a position past 5 p.m. Eastern time, then in your software you'll notice that there'll be a little bit of a charge that takes place referred to as the swap charge. So you'll see here on the terminal there's a little button that says swap. Basically, if you're holding a position past 5 o'clock Eastern time, the companies will charge you a bit of a cost right in here. How do we establish the swap rate? Well, if you go over to the symbol list right here, and let's say we wanted to look at, well, let's pick one, Euro US. Where's the Euro US? Here, Euro US. Click on this one, click Properties, and I scroll down. So let me just do that again. So I'll go View, Symbols, Euro US. Highlight it and click Properties. And as you scroll down, you'll notice a button that says Swap Rate. So it says Swap Long, means if you're a buyer of the US, Euro versus the US, you're going to be charged 2.6594% annual interest. If you're the seller, you're charged nothing. So what does that mean? It simply means that if I was buying the Euro versus the US, let me just pull it up here for a second, I'll show you how it works. So let's say I'm buying $100,000. Okay, $100,000 position, and right in here says I'm buying it. So there's my interest charge on that one standard contract. So multiply this by 2%, which is 0.026594, means the annual interest charge on that contract is $2,659.40, which means every day, divide this by 365 days, there is a swap charge of $7.29. So in your screen here under swap, you would see minus $7.29 because of the interest factor being charged on that buying position, which is called a long position. Okay, so if you're holding a position past 5 o'clock, you're getting charged $7.29 on that standard contract. If that was a mini contract, that would be 73 cents. If that was a micro contract, that would be 7.3 cents. Okay, so just remember that there's a swap rate that takes place every day at 5 o'clock. So if you're a day trader or a session trader, you're not holding positions past 5 p.m. Eastern Time. You should be out of those positions way before 3 o'clock p.m. Eastern Time, in which case you're not getting charged the swap rate. It seems like a very insignificant amount, but let's say you held that position for a whole month. Let's say you were position trading and you felt that the Euro-US was going to go higher against the US dollar over the next month, and you're getting charged every day $7, means in 30 days you're getting charged $210, $216 and the swap rates. Okay, so just be aware of that there is a swap rate that takes place on every currency pair every day at 5 p.m. if you're going to hold a position past 5 o'clock. Second thing you need to be responsible for and understand is that if you have a live account, you have inactive fees, which means, let's say you opened up an account, you opened up with $3,000 and you didn't trade the first month, you didn't trade the second month, you didn't trade the third month. All of a sudden, the company's going to charge you $25 US inactivity fee because you haven't traded. So if you're going to open up a live account, be aware that if you're not trading at all, you're going to get charged a $25 inactivity fee if you don't trade any contracts in a 3-month period. And you should also find out from the brokerage firm you're dealing with as to what their conditions are. Do they expect you to do a certain amount of trades in a quarter every 3 months so that you avoid this $25? Or do they just want you to place one trade, doesn't matter how big or small, over the next 3 months to maintain no inactivity fee? So make sure you know the company you're dealing with. It's all in their conditions where you'll find it. So for example, if I'm using AvaFX as my trading platform, I'm going to go to AvaTrade, which is out of Europe, which gives you that 400 to 1 leveraging. Sorry about this. I'm going to go to avatrade.com. Oh man, okay. Avatrade.com, and you'll see here trading info. You'll see trading conditions and charges right in here. Read the fine print so that you know exactly what you are responsible for, your leveraging power that you're receiving. So it'll give you all the spreads, the leveraging that you get on the different products. It will also tell you the margin requirements. It'll kind of give you all their trading conditions right in here. Okay, and you can see if I go scrolling down, we should see inactivity fee. It tells you customer acknowledges that the customer's trading account may be subject to inactivity fees unless prohibited by law after 3 consecutive months of non-use. And every successive inactivity period, an inactivity fee will be deducted from the account. If I'm not mistaken, that inactivity fee is $25. Okay, so just be aware of that. They also have an admin fee. Basically, the customer acknowledges that the customer's trading account may be subject to an admin fee unless prohibited after 12 months of consecutive non-use. So if you don't use your account for 12 months, they're going to charge $100. Okay, so be aware of the conditions. Every company has a screen like this that tells you all their trading conditions that will impact their trading accounts. You just be aware so that before you open up your live account. Okay, and you can see all the different products that you're allowed to trade. Make sure you stick with the major currency pairs. You have different bonds, commodities, ETFs, fixed, floating, individual equities. Leave the options alone for now. Stock indexes as well. So you've got different products there that you can utilize through AvaFX. The options button here that's referring to this one here is only options on currency trading. There are no options available with stocks with AvaTrade. Only currency options are available, okay, which is a separate software. You can fool around with it under trading platforms. This is the one there for currency options, for somebody that wants to combine currency options along with their currency trading. Okay, so trading info gives you the conditions, rollover chart dates, and so on. Okay, so just be aware of the costs that you're incurring. Now, the reason we're talking about CFDs is because when we did the futures tutorial, you're able to trade index markets. And one of the things about trading indexes, you could trade commodity products. You could trade individual stocks for day trading, not options though. Okay, these are also referred to as CFDs. But in the futures market, when you traded the S&P or the Dow or the NASDAQ, you were responsible for the actual product if you held the contract right to expiry. Here, you aren't. You are responsible for an adjustment that might take place on what we call rollover date. So instead of being responsible for the product, you're responsible for the adjustment between the two contracts. For example, now we're trading the index contract we're trading right now is June's contract. And June's contract, when it expires, we'll start trading September's contract. So if you held your index contract right till the end of the expiry in June, and now we're going to start trading the September contract, there's an automatic rollover that incurs an adjustment cost. Okay, you're not responsible for the product. Same thing with commodities. If you were trading, for example, let's say sugar in the futures market, the contract comes to an expiry, you're responsible for sugar. Either you're delivering sugar or accepting delivery of sugar. That's what your futures contract is physical exchange of product on the expiry. But here, as a CFD, you're not responsible for the product. You are responsible for the adjustment that takes place from one contract that's expiring to the next contract that gets activated. Okay, and I'll show you how that works. Stocks, only a few companies allow you to trade CFDs, stock CFDs, which basically means that you give up your voting rights and you're allowed to trade stocks as CFDs with high amounts of leveraging, which is good for day trading, not so good for holding positions for a long period of time because of the interest charges that you're going to incur on the high amounts of leveraging that they extend to you. Okay, so let's talk a bit about the adjustment. Let's take oil. Okay, oil traded as a futures contract. Right now, if we go to our trading conditions, you'll see where it says CFD rollover. It's going to show you oil. Here's oil. Right now, we're trading June's oil. So we have June contract being traded on oil. And we're trading June's contract, and in the futures market, when this contract expires, if you did not close your June futures contract, you would be responsible for oil, the product itself. But in the CFD market, it tells you June oil expires May 21st, which I believe is a Sunday. So Sunday, May 21st, this contract expires. This is your rollover date. And the new contract is now traded, which is going to be your July contract. Okay? So now all of a sudden, we now have July contract being traded. So let's say you're holding a June contract. Oil's trading, let's say, at $53 a barrel. And you held this contract, right up until Sunday when the rollover takes place, May 21st. And all of a sudden, on this day, rollover, we are now rolling to July's contract. And let's say July's oil opens up at $54. And you are a buyer. You would be all excited because you say, wow, I bought oil in the June contract for $53. The oil contract expires on May 21st. We are now rolling over to the July contract. July contract opens up at $54. And you're happy because you're saying, I'm up $1 on the oil contract, which basically on one standard position represents $1,000 positive. And you're all excited because you see plus $1,000 on your position. But this is a rollover adjustment. You are not allowed to profit from one contract to the other. So what they do is they give you the $1,000 profit on the position itself, but they take it away from your account value. So now they subtract that $1,000 from your account, so your net position is zero. But let's say you don't have $1,000 in your account. What are they automatically going to do? They're going to close your position. Okay, because you don't have the money for them to take it out of your equity, out of your account. On the other token, if you're a seller, contract opens up at $84. This is going to be minus $1,000, but you cannot profit or lose money on an adjustment, so they'll deposit $1,000 in your trading account, so they can bring the net position back to zero. So on rollover date, this would be a Friday, that would be, let's say, May 19. Sunday, market opens up, adjustment takes place May 21st, and you now roll over to the next contract, and your position gets adjusted accordingly. Okay, so you're not responsible for the product, but you are responsible for the adjustment that takes place, because you cannot profit or lose money on an adjustment period. And that's how rollover takes place in the CFD market, as opposed to the futures market, where they would deliver 1,000 barrels right to your front lawn if you were the buyer of the oil contract, or you would have to be delivering 1,000 barrels if you were the seller of the oil contract, futures market. Now CFDs have become extremely popular because of that reason. But also, remember, if you hold a position past 5 p.m. Eastern Time, you incur a swap rate. So every product has a charge. You can find that on your software. You just go View, Symbol, find the product, Oil, Properties, and it tells you what the swap rate is. Swap long or short, minus 1.5%. So you multiply the position by 1.5%, divide by 12, and that gives you your daily swap rate. So let's calculate the one on oil. Okay, so let's see how that one works. Well, oil is a contract size of 1,000 barrels. So if I go oil, properties, it tells you 1,000. Contract size means 1.0. Means that 1.0 contract means that 1 point movement is $1,000. That's what that 1.0 contract means, that 1 full point movement is $1,000. So if you go back to the properties values, it tells you 1.0 means one contract is $1,000 for 1 point. So if you pull up oil, you'll see oil right here. Oil right now is at $53.19. If it goes up by a full dollar on a standard contract to $54.19, that's $1,000. Or if it goes down by a full point, $52.19, that reflects $1,000 on a standard contract. So now swap rate says 1.5%. Whether you're a buyer or a seller, it doesn't matter. So how do we calculate that? Well, we're going to go over to our calculator. We're going to pull up oil. It's at $53.19 a barrel. Oops. Multiply that. Every dollar is $1,000. Oops. So there's the contract size. Multiply this by 1.5%, which is 0.015. There's your annual swap rate. Divide this by 365 days. There's your daily swap rate, $2.18 a day if you're holding a position past 5 o'clock on oil. Now, let's go back to the to the symbol list, you'll notice that every product has a swap charge. However, there are 7 days in a week, but trading is only 5.5 days. It goes Monday, Tuesday, Wednesday, Thursday, Friday, and then you have a Sunday night where trading starts again around 6 o'clock or 5 o'clock, depending on the product. So you're going from 6 p.m., let's say Sunday, until let's say 4 p.m. on Friday. In between there, you're getting charged for a swap rate every day. So to account for the swap rates at Friday at 5 p.m. and Saturday 5 p.m., they charge you 3 swap rates on Friday to account for the weekend. So on the weekend, you got to pay a swap rate for Friday, you got to pay a swap rate for Saturday and Sunday. They charge you 3 times the swap rate on Friday to accommodate for the weekend. So if you held a position past 5 o'clock on Friday, you're getting charged 3 times the rate. Okay? Now, let's take a look at a currency. If you were holding the euro, you'll notice the euro is a bit different. If you hold the euro on Wednesday past 5 o'clock, they charge you the weekend on the Wednesday. So they charge you 3 swap rates on Wednesday to accommodate for the weekend. Okay, so be aware of the different swap rates. Ideally, if you're going to be a day trader or session trader, you shouldn't be holding positions throughout the whole day and into the next trading day. You should be getting in and out of the market while you're sitting in front of your computer. The ideal times to trade, like I mentioned, midnight to noon, you wouldn't be incurring any swap rates if you bought and sold and closed your positions within that time frame. Okay, so it's important to know the different products and their swap rates and their properties, the size of their products, because every product is different. Okay, so CFDs, all your products that you trade as futures, you can also trade them as CFDs. Agricultural products, like your grains and your soft markets. You can trade your metals like gold and silver. You can trade your energies like oil and crude oil, Brent oil, and heating oil, and so on. You can trade all your index markets like the S&P, the Dow, the Nasdaq. You can, and other indexes around the world. You can trade bonds, and you can also trade your foreign exchange market. And they also allow you to trade some stocks, okay, from around the world. Now, be aware of the hours of operation. The hours is very important. Not everything is 24 hours. So where do we find that information? If we go back to our trading info, trading conditions, you'll see right in here, it tells you the hours. Notice 24 hours, 5 days a week. All the way down for currencies, 24 hours a day, except for the ruble. Everything else, pretty much 24 hours a day. Now, if I wanted to look at some indexes, stock indexes, so I wanted to look at the S&P 500, GMT time, it tells you GMT time, 2200 hours to 2014. Well, GMT time is 5 hours difference between Eastern time. So 2200 hours is, I believe, that's 10 o'clock. Yeah, 10 o'clock. And then you subtract, GMT would be minus 4 hours. So 10 o'clock minus 4 hours would be 6 o'clock in the evening until 4:14 in the afternoon, and then they close and they open up at 4:30 until 5 o'clock, and then they close and they open up again at 6. Notice how confusing it is in that time there, and you'll notice that most of your indexes are like that. And if you're looking at trading the DAX, which is German index, 6 a.m. to 8 p.m. GMT time, so subtract 4 hours would be 2 a.m. until 4 p.m. 4 p.m. on the German DAX. So you just find the hours. This all refers to GMT time. Okay, so you can see the hours that each product is trading if you want to trade other indexes other than the North American ones. They don't trade 24 hours. They do take a break. You can see how they kind of break up here. If you want to trade products like individual stocks, you want to trade some US stocks like Apple for day trading, it tells you 1:30 a.m. to 8 o'clock p.m., which is, again, Eastern time. Sorry, GMT time. So 13 would be 1:30. Subtract 4 hours would be 9:30 in the morning till 4 o'clock in the afternoon. You can day trade individual stocks. They give you huge amounts of leveraging, 20 to 1. So do not hold these positions overnight because they're going to get killed with swap rates. Okay, and it also gives you other stocks that you might want to trade as well. Other than US, you can trade some European stocks. Just scroll down and you'll see the UK stocks, and you'll see Spain and so on. Germany, different other stocks that you can trade as well. So whatever product you choose to trade, you can see the trading hours and their leveraging and so on just by going to the trading info, trading conditions, pick the products, and it'll tell you how much money you need with regards to margin requirement in order to participate. Okay, so you can see I could trade Apple with a 5% margin requirement for day trading. So Apple's let's say $140 stock. I put up $7 a share. I can buy and sell this stock all day and day trade it. But don't forget, if you're going to hold it past 4 o'clock into the next day, overnight, you're going to get charged swap rates. Okay. Any questions on CFDs and the hours of operation and how to find all your trading conditions and so on? Yeah, I can address that question. Okay, so symbol list is where you find the product. Okay, so symbol list. So if I take any product, let's take gold for example. Gold, click on it, properties, one contract. In other words, if I'm trading a standard contract, 1.00 means that $1 movement, one full movement on gold is going to equal $100. Contract size, 100. So that basically means that a standard contract, $1 movement, is $100, up or down. Okay, so if you're trading a standard contract, that's what you're looking at. That could be a pretty big position. Okay, I'll give you another example. If we go to an index, okay, let's take the Nasdaq. Properties, contract size, $100 a point. So if you're trading a standard contract, means $1 on the Nasdaq is $100. Now, if you recall from the futures tutorial, $1 movement on the Nasdaq futures is only $20. So if you're trading a CFD contract, you're trading 5 futures contracts, 5 times as much. Very dangerous. You want to mimic the same, you would trade 0.20 to mimic the futures market. So be aware of the products, what their values are in the futures market. So if you're going to trade indexes like the S&P or the Nasdaq or the Dow, one standard contract on the S&P is $100 per point, $100 per point, $100 per point. But in the futures market, this is $50 a point, this is $20 a point, and this is $5 a point. So notice here you're trading 2 contracts. Here you're trading 5 contracts. Here you're trading 20 contracts. So be cautious, because these are huge positions when you're trading through AVA and you're trading the contracts. So if you're trying to mimic the futures market, make sure you know the product values. Okay. I have another question. How come on the currencies it says one point movement's $100,000? Well, let's take a look. Euro US contract size, which means, let's take a look at that. 1.0 means one full point movement, $1 movement is $100,000 in the currency market. Okay, now let's go back to the quote. See what says 100,000? Okay, now let's take a look here. If I take the Euro US, it's quoted at 1.06428. Okay, so here's your quote, 1.06428. So that means that if the euro went to 2.06428, 1.06428, that would be $100,000. But that's not going to happen. So what if the euro only moved, let's say, well, remember this is your fraction, right? Let's say it went from 1.0642 to 1.0672. I'll put that 8 in brackets here. So from 42 it went to 72. How many pips is that? That's 30 pips. Okay, well, what's that worth? Well, this number here is worth $10,000. This number here is worth $1,000, which means this number here is worth $100, and this one is worth $10. So everybody got that? So if this moved by 30 pips, there's your pip, $10, means that you have a $300 move took place on that currency move. Okay? So you can establish, and that's approximate. Not every currency is $10. Okay? So you can establish your position size just by looking at your symbol list. So if you're not sure of the product, go to the symbol list, find the product, highlight it, properties, coffee, contract size $1,000, means 1 full point movement on coffee is worth $1,000. Okay? So just be aware of the size of the product that you're looking to trade so you can establish your position size. Okay? Okay, now let's move on. So we have products that we can trade, Forex, which is our currency pairs. We have index markets, which would be like the S&P, the Dow, the NASDAQ, and other indexes around the world. We have energy products like oil and gold, metal product. Again, very, very popular products to trade. But you can also trade the other products, your agricultural products like grains, wheat, corn, soybeans. You can also trade other soft market products like coffee, sugar, cocoa, and other soft market products. So you've got and you can also trade some individual stocks as CFDs. So you've got a lot of products here that you can participate in when you trade in Europe, like a company like ABBA. But remember, your money is not protected. In Canada, you can trade currencies, you can trade indexes, you can trade oil and gold, but you cannot trade individual stock CFDs unless you go to a specialty company like CMC Markets. Okay? That's the only company that allows you to trade individual stocks as CFDs, but you're not going to get the leveraging you do get when you go outside of Europe. But because CMC is licensed in Canada, your money is fully protected. So you have choices where you can open up your accounts. You can go to Canadian broker. So if you're planning to open up a large account and you want the full protection, you can go to companies like Owanda. I'll let you trade Forex and indexes, oil and gold. You can go to Forex.com. Again, they'll trade Forex, indexes, oil and gold. You can go to Gain Capital. You can trade your Forex, indexes, oil and gold. You can go to CMC Markets and you can trade your indexes, your currencies, your indexes, your oil and gold. You can trade other commodities as well, like wheats and corns and soybeans and coffee and so on. And you can also trade individual stocks as CFDs. Just remember, leveraging is not that high in Canada. You're not going to be able to leverage your money significantly, but that's okay because if you have a large account, leveraging is not that important. But if you open up a small account, then you need to have the leveraging. And the more leveraging you get, the more advantageous it is for you. Now, I have a question that says, can you get into a deficit? Absolutely you can. You can end up owing the company money if you're on the wrong side. Think about, let's say you had $1,000 in your account and you opened up a standard currency position, $10 a pip. Let's say you opened this position on Monday. You kept holding the position day after day after day, all the way to Friday. You're losing money on this position. Remember, you're putting up $250 security with ABBA to maintain the position. You have $750 what we call liquidity. All of a sudden, by Friday, your position's minus $750. And you decide, oh, what the hell, I'm just going to hold the position into the weekend because I've already lost most of my money. What else can I lose is $250? Well, wrong. let's say that Sunday, market opens up again at 5 p.m. Some bad news hits the European market, and the euro opens up minus 200 pips from where it closed on Friday. That's minus $2,000 on a standard position. You only have $250. You now have a deficit of $1,750. So you owe the company money, and they're going to come after you for it. Okay, so yes, you can go into a deficit when you're holding positions during times when markets are not moving. Okay, when a market's trading and it's actively moving, there are ways to use what we call stop loss orders to protect yourself and limit the risk. But on a weekend, or when there's a bank holiday, or when markets are not trading, you can end up in a deficit if you're on the wrong side from the time the market closed to the time it reopens. So be aware of that. And they will come after you for any deficits that you incur. Okay? Any questions on the basic overview of Forex and CFDs? Okay, the next thing I wanted to talk about is your trade plan. Like, what are the rules that we would follow in order to trade these markets? Now, I'm going to refer to session trading. Session trading is like day trading. We call it session trading because you're going to be trading sometimes at night in addition to daytime. So as long as you don't hold positions throughout the night when you leave your computer, then you're called a session trader, also referred to as day trading. Okay. Session trading is more for a 24-hour market. Day trading is more for a market like stocks, for example. Stocks would be referred to day trading because you're trading 9:30 a.m. to 4 p.m. So anytime here, that would be day trading. This is called session trading, 24-hour day products. Not all products trade 24 hours, but a lot of products do trade pretty close. Okay, so we need to follow a routine. First thing is, we're running a business. So you want to set your hours. So what hours are you going to participate? You know, some of you might be able to trade in the daytime because you have flexible hours. You don't have to be at work early in the morning. Some of you might have a job and you might want to trade late nights or early mornings. So set your hours. Next thing is, know the products that you're trading. So what are their point values? Make sure you understand if they have a swap rate. What is the charge if we're going to hold a position past the end of the day? Inactivity fees. So make sure you know your products. What are their tick values or point values or their pip values if you're trading currencies? Make sure you know your products. Okay? Very important. Make sure that you have a working environment that's comfortable. So if you're trading from home, you might use your laptop. And every laptop has a secondary video card, which is your coaxial cable. You can pop that into another monitor and expand your monitor workspace. If you have a more modern laptop, you also have an HDMI plug. You can expand that into a big screen TV. You can create a 3-monitor system. You can use your 3 monitors to trade the various products, look at different charts, expand your workspaces so that it's comfortable. When you go on holidays, you take your laptop, and if you happen to go to a hotel that has a flat screen TV, which is nothing more than a monitor, you can plug into the flat screen TV and expand your workspace. So it's a portable environment. So you want to make sure you have an expandable workspace. You also want to make sure, because you're running a business, you're trading more actively, you want to have backups. Backups for hydro would be your laptop because it has a built-in battery. Backup for your internet would be your smartphone because you can create a Wi-Fi zone. And if both go down, telephone is your backup. So make sure you have your broker on speed dial. Now, your trade plan. You need to follow a routine when you're going to be day trading or session trading. You need to follow a routine that you're going to do over and over again. So every morning before you start trading, you need to do some research. So research, if you're going to trade currencies, you want to make sure you have an economic calendar available so that you know all the economic reports that are being announced during the day that you're going to be trading. If you're going to be trading indexes and other products, you also want to have a TV. You can have CNBC in the background or Bloomberg. so that you're aware of anything that's not on a calendar is an uncertain event. And through TV, you'll be able to hear in the background what's happening around the world. Also, CNBC has a mobile app that is quite good, especially if you're going to trade individual stocks or index markets, like the S&P, the Dow, the NASDAQ, and so on. Because the mobile app from CNBC will send you big companies in the news that might have an impact on the S&P, the Dow, or the NASDAQ that you can take advantage of trading those index markets as CFDs in the mornings. So CNBC, great little application. In the background, you'll hear them talking about economic reports. So you'll hear about different companies in the news. So either use your TV or your mobile app or both. At nighttime, Bloomberg seems to be more effective for the European markets. So where do we get our economic calendar? Always be aware of what's going on with regards to the economy. So Monday, you can see there was a bank holiday, so nothing really happening. But tomorrow, you'll actually see, let me just change this to the 18th. You'll see tomorrow, 8:30 in the morning, there's red reports, high impact reports. This is going to have a big impact on the US dollar, building permits. Then you have some medium impact reports coming up, and you have a medium impact report on the Canadian dollar. And you'll notice that this is the last time the report came up. That was the report number. This is the forecast that they have right in here, and then this will be the actual number. Tomorrow, all you have to do is refresh your screen at 8:30, click the refresh button, a little clock pops up, click the clock, and the number will pop up. If the number is green, it's better than what they expected. Red is worse than they expected. Gray is in line with what they expected. And you can sort of gauge that right now they're sort of looking at the Canadian dollar, and they're saying that we're going to get less foreign purchases coming out. On the US building permits, they're looking for more. So you can also gauge through kind of looking here as to what everyone's anticipating. But if you get some surprise announcements that fall outside these parameters, that could be a significant impact on the currency, especially the red reports, which are high impact. Not sure what that means, just click this little detail button. It tells you where the report comes from, what it measures, and how it impacts the currency. And it also gives you some of the reports that were what they looked like the last time they were announced. Okay, so this will kind of give you a little bit of an insight as to what's happening on the day. There is another area you can get some reports from as well called, I think it's called Daily FX. I believe that's Daily FX has a little button called News. And news around the world, we'll kind of scroll in, and you can keep this open where it says News. More real-time news. And if you leave this on, you can even minimize it and put it on one of your monitors. And you can have here all news or specific news coming through. It's your choice. And you'll have news coming in. It'll scroll in. You can see it here. And you can click on it if you want, and you can kind of read it. Your choice, how you want to see the news. Okay, so you can see it scrolling in right now. All the news is here. And it just kind of scrolls in. And you can see this is going backwards right now. It's just kind of giving you a refresh. But just another way to view some news reports coming in. Okay, ideally, if you use Forex Factory, it's far more efficient. At a glance, you can see all the economic reports on the calendar. Now, that's basically a little bit of research just to make sure that you know what's happening around the world and you know what's happening on the calendar. The more important research is your technicals. And you're going to use technical analysis to make your decisions when you're trading the various products. Technicals, you're always looking for support resistance areas where prices have been before that might have an impact so that you can see, are we getting a break through support or resistance? Are we bouncing away from support or resistance? I'm going to be looking at those levels as important levels, looking for patterns. If you recall, we talked about reversal patterns, continuation patterns, and uncertain patterns in the program. So reversal patterns would be like your double top and double bottoms. These are resistance areas, that's a support area. A break below this little valley says we're continuing lower. A break above that peak, we're continuing higher. Head and shoulders, a break of the neckline, looking to go lower. Invert head and shoulders, a break of the neckline, looking to go higher. Continuation patterns, bear flags, looking to go lower. Bull flags, which are symmetrical patterns, looking to go higher. Inclining wedges, looking to go lower. Declining wedges, looking to go higher. Descending triangles, looking to break down. Ascending triangles, looking to break up. Uncertain patterns, symmetrical sideways breakouts, one way or another, or the narrow range channel breakouts. These are sort of, at a quick glance, some of the patterns we talked about that you want to be familiar with. We also mentioned about candlesticks. There are certain candles that you want to look at on a bigger time frame. So if I'm a day trader, I'm looking at 5-minute intervals to execute my trades, but I'm trying to take trades in the direction of my bigger time frame. Once in a while, I'll see a candle that might give me a quicker entry point. So candles, I would be looking for what we call bearish reversal candles and bullish reversal candles. So for example, price have been rising on this 60-minute time interval. All of a sudden I get a candle that tries to go higher and then kind of breaks down and closes lower like this. So you get this negative candle that's called a reversal candle, bearish reversal. The opposite would be when price have been dropping. So you've got all these negative candles, and then all of a sudden you try to go lower, and then price closes up higher, creating a bullish reversal. The other one you'll see is called an outside reversal, where you've got, let's say this is a positive candle, and this all of a sudden the body of the next candle turns negative, but it exceeds the body of the previous candle. That's a very powerful reversal candle. And again, in this example would be, this is a negative candle, and then the body of the next one opens up and exceeds the body of this one positively, like this. And these are called reversal candles. So when you're a day trader, a session trader, you're looking at your patterns on a small time frame. You can also look at them on a bigger time frame. You want to use a small time frame trade in the direction of the bigger time frame, and you're looking for candlesticks on your bigger time frame that might give you an early entry point. And there's also inside candles. So you could have a positive candle with a little positive one inside, nothing more than a triangle, or it could look positive candle with a little negative one in here. Again, it's the triangle that you're looking for the breakout, or this could be negative with a positive one, again, looking for the triangle breakout, or they could be both negative. It doesn't matter. This bar here, this candle's inside this one on a 60-minute chart, looking for a breakout. Okay, so keep in mind that there's a lot of technicals that you should be looking at, and if you're not quite comfortable with looking for support resistance patterns and so on, then look for mechanical approach, MACD, RSI, exponential moving averages, when they all come together to point in the same direction, but make sure you have an entry point, a break of a previous peak or a break of a previous valley to signal an entry point, okay? If you're going to use strictly the mechanical. Or this could be a resistance area break where you've had a test numerous times, or this could be a support area break that's been tested numerous times. So your mechanical approach, very important that you have an approach. Next thing is, once you establish an opportunity, you need to identify risk. And this is important because where you enter the trade from, you can measure the distance to where the previous valley is, or you can put your stop loss order. Measure that distance, and then establish your position size. Okay, so here I'm selling, there's my stop loss. I can measure that distance to establish my position size. So for example, let's say this was 20 pips on a currency, and I know that one standard contract, if I'm trading a standard contract, the average pip is approximately $10. I need to put my stop here, 20 pips away. That's going to be minus $200. I don't want to risk 200, only want to risk 100. Then instead of trading a standard position, you trade 0.5 50, half a contract. If you're trading an index, let's say this was a 4-point stop on the S&P. Each point's $100. I don't want to risk $400 on this trade. I only want to risk 100. That means I'm going to do 0.25 position to accommodate $100 risk. It's important to know where you're getting in, where you're putting your stop loss order, and what's the distance. Because the product you're trading, if you're going to trade a standard position, you want to know what kind of risk does that mean on that trade. Okay, so that this way I can adjust my position size according to the risk tolerance. If you're opening up an account, let's say you opened up a $3,000 account and you went to AvaTrade, and you need to know your daily risk and your per trade risk. So if you're not going to risk more than $300 a day and you don't want to risk more than $100 per trade, it means that you can have 3 losing trades in a day. So if you're willing to risk $300, then you need to know how much are you willing to make. So you can quit for the day. Maybe your target's going to be $300. It doesn't mean you're going to reach your target every day, and it doesn't mean you're going to take 3 trades every day. Okay, so make sure that everything is realistic of how you're entering your positions, where you're putting your stops, how much money you're risking per trade, so you can establish your position size. In addition, you need to know all your different order types. If you recall, a market order, want to buy or sell right now at the market. That would be this price right here. There's your buy at the market, sell at the market. If I wanted to use a limit order, I want to buy at a better price in the market, or I want to sell at a better price of the market. That means that if I'm buying below the market price. If I'm selling above the market price to get a better price than what the market price is. So if market price here, I want to get a better price. I want to buy limit, I'm buying down here at a better price. Sell limit, I'm selling above the market at a better price. Then you want to know stop orders. What's a stop order? I want to buy only when prices are penetrating a certain level. Buy on a stop, sell on a stop. In other words, buying above the market on a stop or selling below the market on a stop. These orders are extremely important to know how to use them. And OC orders you can do on your software as one order. So let's say you're in the market, you bought. You put your stop loss below the market to protect yourself. You might put your take profit order above the market to take a profit. This is called an OC order because all these orders are linked back to your original order. Okay? Or the same way, I'm selling at the market. I put my take profit below because I'm looking for the price to drop, put my stop loss above. These both orders are linked to that original order, called a bracket order or an OC order. Very important. And you can turn a more sophisticated order called a trailing stop order. So you take your stop loss order and you can turn it into a trailing stop in order to move as the market moves in your favor. So make sure you're aware of your order types, because risks come from not knowing the order types. Risks come from not knowing your product values. Like I mentioned earlier, knowing the products, the swap rates, the expiry dates, the rollover dates. Very important. Okay. Finally, your strategies. You need to know how are you going to trade. There's choices. When you're day trading, you're not using options. When you're day trading, you're using the physical product. So you have choices, all in, all out. Means whatever position I start with, I close the entire position. I could close it manually. I could close that entire position with a take profit order or a stop loss order or an OC order or a trailing stop order. Pillaring. Let's say I'm expecting a big move to take place. I can add more positions to an existing trade by using a stop order to increase my position size. Scaling out. As I hit targets, I can start closing some of my positions so that I can start reducing the position size, gradually putting money in my pocket. So I've got some choices when you're trading and day trading the different products. Finally, you have your expectations. Always have a couple of targets in mind. Where's target 1, target 2? There's always a decision process that takes place at target 1. Target 1, do I get out? Do I close all my position? Do I close part of my position? Do I add a position? Right? Scaling out, all in, all out, or pillaring. You can use a simple method, support resistance. On a small time frame, these are called minor. On a bigger time frame, they're more important. They're called major. Always have a couple of targets in mind as to what you expect is going to happen. If you're more of a sophisticated trader, you can use Fibonacci levels, and you can use your pivot point calculator. Okay. Now, this is your trade plan. Research, risk, strategy, expectation. You might not remember all the components of it because we have talked about them, but maybe you're not familiar with everything. We do have a hands-on week coming up where you can watch me do it Monday to Friday. The next hands-on week starts May 8th to May 12th, Monday to Friday. It goes 9:30 a.m. to 12 noon, so you can get a taste of how it's done in the real market. So you can actually see the trade plan. We're going to go through every component of it slowly throughout the week so you can actually get comfortable with it. We're going to take trades every day based on the trade plan so you can see how the trades are executed, so you can get comfortable with clicking the buttons. You can use your demo account to follow along. You can use a live account if you're at that stage, your choice. The cost for the entire week is $99 plus HST. You're only paying for the technology fee. What that allows us to do is broadcast, record it, and put it on a server so you can review the recording for the next 30 days. Okay, we hold a hands-on week. We try to do it every month and a half. So it gives you a chance to participate whenever you have the availability. If you're not available, you can still pay the fee. Dundee will open up the access to you so you can at least watch the recording for a month until the next session starts. Now, as you practice, you're practicing on your demo accounts to perfect your trading plan so that you start following the routine to participate in your trades. I have a question here. Yes, you can go from session trading or day trading to position trading or swing trading. Absolutely. If you're holding a position that you feel is making you some money right now and you want to turn that into a position that's going to be with you for the next 2 or 3 days, you can put in your trailing stop order or you can put a take profit order and just hold on to the position. Just be aware that every day there will be a swap charge taking place. And if you're trading certain products that shut down, just be aware that you could be exposed to additional risk during the times that market shuts down and reopens. But there's no rule that says you can't hold a position for days or weeks or months to come. Just be aware of the swap rates and the risk involved if you're holding positions into times where markets shut down and then reopen at a different time. Okay, you're using your demo account to kind of practice in the beginning. So you're going to have winners and losers, and make sure you have a log for yourself. Like just print off your charts with your notes on them so that you can actually see when I was making money, what did I do right? When I lost money, what did I do wrong? So you can kind of get a feel for winners and losers. The software that we're going to be using to practice with is a generic software. It's called MetaTrader 4. It's available pretty much with any foreign exchange or CFD broker. So even though I'm going to be using AvaTrade for my MetaTrader platform, you can use anyone else. You can use Awanda, Forex.com, Gain Capital, whoever you want. They all have MetaTrader available, and it's all used the same way. Okay, so MetaTrader 4 is the standard software that everybody uses that's trading foreign exchange and CFDs. So let's take a quick look at it. This is the software once you format it. So what I'm going to do is I'm going to clean it up, kind of show you how the software you're going to get it. So first thing is, how do we get the software? Well, you're going to go over to learn-to-trade.com. You're going to log into the member section, which is going to come to this page right here. You're going to click the button that says Forex. Under Forex, you're going to see 2 buttons. Forex tutorial. This is the button that you clicked here to join me tonight online. This recording will replace this recording so that you can review what happened today for another month until the next meeting comes up. If I click the back button, you'll see a button that says Trading Software. You click on this button, you register your demo right here so that we know that you're a Learn to Trade member. Okay, so if you can go directly to AvaTrade's website, but you're not going to get the service or the help that you would get if you register through the Learn to Trade website. Once you do that, you're going to go fill in your name and so on. The trading platform I use is called Floating Spread. It's a MetaTrader 4 platform. but the spread is not constant. The reason for that is because I trade during market volatile times, which is the daytime, so my spread reduces. But if you're going to trade at night, because you don't have the available time in the mornings, you might want to go with a fixed spread MetaTrader platform. It just means that your costs are going to be a little bit more than what mine are on the floating spread. Your choice. I would suggest floating spread if you are able to trade during the volatile periods of the day. But if not, then use the MetaTrader fixed spread, okay, which is constant. Okay, so either choice, one or the other, it doesn't matter. Whichever one you register for, though, that is the one you're going to download when you go to the trading platform. So trading platform, you pick the one that you registered for, floating spread, if that's the one it is. You scroll down, and you go download floating spread software. You download it. Right here is a video tutorial. It shows you basically how to use the MetaTrader platform. There's quite a few videos in here, quite extensive. I'm going to go through very quickly how to use the more important features. Okay? So once you've done that, you now are ready to download the software. You've already downloaded, you've watched the videos to learn how to use it. And I'm going to go through the software right now, show you how to use it more, a little more efficiently the way I use it. Okay? So let's just kind of go back. And now we've downloaded the software. An icon will appear on your desktop, which is this one right here. I don't know if you can see my little cursor right at the bottom. That's the icon that will appear when you download your software. You're also going to get a username and a password, which you're going to use in order to log into your demo account. So log into the account. Your login will be an account number. Your password is the one that you chose. Your server is the one that they're telling you to log into for your demo account. A few choices here. This is most likely the one that they're going to ask you to use. So once you've done that, you're going to log in. You're going to see down here, right at the bottom, a bunch of numbers that will scroll telling you have live data. If you don't have these numbers at the bottom right corner, you are not connected. You have no data. Okay, so make sure that you've connected properly. Once you connect, you're not going to have all of this stuff showing up. So I'm going to delete all this for now. What you're going to have is a bunch of charts that are going to look something like this. It's going to kind of look a little awkward. And every chart's going to look different. So it's going to be a little confusing for you in the beginning. So I'm just going to sort of improvise and kind of show you what each chart might look like. Not only will every single chart look different, but every possible window you can think of is going to be opened as well. So all your toolbars are going to be open, which kind of reduces some of your space on your screen. You're also going to have, in addition, you're going to have your navigator is going to be open, which is your detail of your account. It's also going to have your watch list is going to be open. Your terminal is going to be open as well, which you don't need all this stuff open. So this is what your screen is going to look like when you first download the software. So what we want to do is we want to get rid of a lot of the stuff. Down in here is your terminal. It's going to show you your account size. And you don't need this right now because there's no trades going on. You don't have no open positions. We don't need that. We only need it when we place a trade. So I'm going to minimize that just by going to View, Terminal. Open it up when we have a live trade going. Shut it down when we don't have any trades going. And here is your account details. So you don't need this. So we're going to go View, Hide the Navigator. Right in here, you'll notice that I've got a few products open for trading. If I show you how many products are available, there's hundreds and hundreds of products. You're going to have to go through each little box and pick the products that you're most likely to want to trade. So as we go through, you'll see Euro US is the most popular currency, so I've got it highlighted. And it appears on my watch list. US Japanese Yen, if you want to highlight it, you just click on it and go Show. And it'll pop it up on your screen. Anything you want to activate, you can just highlight it and activate it. Now, try to streamline your watch list to look similar to what I have right here. Okay, don't go putting too many products in there through your AVA account. Okay. So I'm just going to open up a few windows. This one here, I don't really use it, so I'm going to click on it and I'm going to hide it, get rid of it. So you'll notice Euro US, Australian US, Euro Japanese yen, British pound US, US Canadian, oil. I don't trade any of these products in here. Notice none of them are highlighted. The next set here, all minor currencies. I don't trade any of them. I don't trade any of this stuff. I don't trade any of this stuff. Notice I've got lots of stuff that's not highlighted. I don't trade Bitcoin. If you want to, you can. I trade gold. I like gold. I don't trade any of this product. I don't trade any bonds. Indexes, NASDAQ, S&P are my favorite. I don't trade any of these products. You could if you want to. Notice I don't have a lot of products highlighted. I don't trade, Asian indexes or European index. I don't trade soft markets like coffee, sugar, cocoa, or any of this stuff. You could if you wanted to. I don't trade any of this stuff. Notice there's so many products there. When we get into stocks, I only pick a few stocks that are quite volatile in the daytime that you could potentially make some pretty good money if you don't have anything else to look at. You can pop in a few American stocks. I don't do anything with the European stocks. None of this stuff I activate. So you can see that I've got some stuff that I've activated, and just stick with stuff that you're familiar with, and keep it simple. You don't need to have a lot of products to day trade. Okay, so I streamline my watch list to the stuff that I'm most likely to participate in. You can see them right here, and you get familiar with each product that you're trading. So you want to know, if I'm trading a standard contract, what's one full point movement worth? And every product is different, so just be aware of it. So if you're going to trade currencies, you know that a pip, which is your second last decimal point, your second last decimal point is worth $10 on a standard contract, $1 on a mini contract, and 10 cents on a micro contract. Your S&P and NASDAQ are worth $100 a point. Gold is $100 a point. Crude oil is $100 a point on a standard contract. Stocks are different. Some stocks, like Facebook, are $1,000 a point, because $1 movement's $1,000 because you're trading 1,000 shares. Stocks like Apple are $100 a point, which is 100 shares. Okay, so just be aware of the property values of the products. Not sure? Go back to View, Symbols, pull up the stock or pull up the product you're looking to trade, click on it, go Properties, contract size, $100. One full point movement, $100. So you're trading 100 shares. Okay, be aware of the products. Once you've done that, you don't need this anymore, because all these symbols are right here. File, New Chart. And they're all right in here. Every single stock, index, or currency that I have in my watch list is on my file list as well. So I can pull up a chart on any of these products. Okay, so I don't need to have this constantly open. But I could open it up when I want to see a symbol value. Okay, so I'm going to hide this. View, hide my watch list. Now I've got 4 charts. I'm going to go Windows, File, Windows. So I can spread the charts over to take up the big screen. Right up in here, I've got all these icons available. What's important is all of this stuff is also available by right-clicking on your chart. Time frames, templates, everything is right-click. Or you can also go View, and you can kind of see Insert. You can see all your lines and your Fibonacci and shapes. Everything's right there. Charts, if you want to go to candlesticks and so on. Everything is there already available on your chart. So the only one that's not available is this one right here, that cursor. Well, you can get that cursor as long as you attach a mouse to your laptop. It has a middle ball on it. The middle ball, click on it. You can go back and forth. Right click, left click, it disappears. Click the middle ball, brings the cursor back. Left click, right click, it disappears. Okay, so everything here is available under these icons except for this one here. Okay, so you can activate it just by using a mouse attached to your laptop with the ball in the middle. So I'm going to hide all these icons. But before I do that, I'm going to take my first chart, and I'm going to make sure it says candlesticks, make sure that both of these are clicked down, and make sure it says 5 minutes. Okay, so one chart, so I can format it. Click the one chart, make sure it says candlestick. Make sure this is suppressed, so it automatically scrolls. Make sure there's a shift in between. I can even minimize this shift just by doing this. And make sure it says 5 minutes. Okay, so right in here I can kind of do this, and I can minimize my shift area. Once I've done this, I don't need these icons anymore because all of this stuff is available by right-clicking on my chart. Oh, one more thing you want to do? Well, we'll do that shortly. View, toolbar, I'm going to hide all this stuff now. View, toolbar, hide everything. I don't need any of this stuff. Okay, so now I've got one big chart that takes up the whole window, and I've got my icons, my links at the top. Now, I want to make sure I activate what they call one-click trading. So I'm going to go where it says Tools, Options, Trade, and make sure you activate one-click trading. Okay, so this way you don't have to double-click to confirm your order. It's one click. Okay, now that I have a one-click order on my chart, I'm now going to clean this chart up. Right-click, Properties. I'm going to get rid of all of the different colors. I want white background. I like my front to be black, my grid to be fainted in the background. My up bar outline and my down bar outline is black. My inside bullish bars are white to reflect up. My bearish my bearish candles inside are black. My line graphs are black. My volume bars are black. My asking line is green, and my stop levels are red. This is my color scheme under my properties. Under common, I'm going to activate the asking line. Click OK. Now I want to get rid of all of these indicators that exist there right now by right-clicking on the chart. And I'm going to go where it says indicator list, and I'm going to get rid of all of that stuff that's on there. Just get rid of everything that's there. It's going to get rid of all of that stuff that's under indicator window number 1, window number 2, and so on, all the way down. Just get rid of everything. And I got a clean chart. Okay, there's my clean chart. Now what I want to do is I want to point out green is your asking price, black is your bid price. So here's your screen. There's the buy, there's the sell. Buy is the green, sell is the black. There's a difference between the two called the spread, and that's the cost you incur for placing your trade. No commission charges with AVA. Your charts are always reflecting the bid price. So if I'm buying, my buy price will be way up here, even though the chart is reflecting this price, okay? And you can't have the chart reflecting both prices. It only reflects one of them, which happens to be the bid price. So it's very important to know that, because let's say we bought into the market. So here we bought, and we want to put a take profit order up here. Well, as the price moves in that favor, you have two boxes. You have a green box and you have a black box. Now remember, we bought at the green box. We sell at the black box. So as the price is moving, it's the black box that has to hit that take profit order in order for you to be able to close the position. If the green box hits that take profit order, you're not filled, because you buy on the green, you sell on the black. By the same token, if you're a seller, you're selling at the black box, you buy back at the green box. So you're looking for the price to go down, and let's say you put a take profit order here because you want to get out when it hits this price. This is your sell, this is your buy, right? So sell means that the green box has to hit that take profit order in order to execute your trade. Let me show you what I mean. Okay, so I'm going to place an order. So let's say I was a seller. I click the sell button. There's my order now. I've now executed a trade. So there's my sell order. Let's say I want to put a take profit down here. I left click, hold and drag. There's my take profit order. That's order sitting in the market waiting to get filled. In order for me to execute my trade and get filled, it's the green box that has to hit that line, not the black box, for that order to get filled. If the black box hits it, you're not going to get filled because you sold and you need to buy back in order to close the position. So there's your sell order. That's the order we place at the market. In order to be able to close that position automatically when it hits this take profit order, it's the green box, which is your buy box, and has to hit that order. Okay, so I'm going to close this trade out for a minute. Close this both out. Now let's do the buy side. I click the buy button. Okay, now I bought. Now, let's say I want to take a profit when it comes up here. Left click, hold and drag. There's my take profit order. The price starts to go up. It's the black box that has to hit that line. Remember, we bought. This is the sell box. okay? So in order to execute. Sometimes I'll get an email that says, oh, George, you know, the chart came up and hit my price, but I never got filled. Well, look at your asking price, look at the buy price and the sell price, and make sure which line is supposed to hit your order in order for your order to get executed. Okay? So let's start putting in our indicators. By the way, you can go up and down by holding this up and down, and you can sort of magnify. You can also do the same thing at the bottom. Okay? I don't like to go too wide. I don't like to go too tight either. I want to be able to have a pretty decent view of the chart. So I start off with something that's, kind of close together, and then when I want, I can always open it up to get a closer view. Okay? So I'm going to put in my moving averages. Insert, indicators, trend, moving average. I want 8 exponential, on close, green. Make it a little thicker, click OK. Then I'm going to go again, insert, indicator, trend, moving average. 21, exponential, on close, color coded red. Make it a little thicker, click OK. There's my exponential moving averages. Now I'm going to put in my RSI, which is an oscillator, relative strength index, parameter 21, make sure 21 on close. I color code everything black. Levels, you're going to have the 70 and 30. This one will not be there, but you click add and you type in 50. And then click add again, color code everything black, click OK, there's my RSI. My MACD, unfortunately I won't be able to put it in as simple as insert indicator. So what I'm going to do is I'm going to have to bring it in through the MetaTrader 4 codes that are available. So in order to do that, you're going to have to default your internet browser to Mozilla. And just want you to know that Mozilla is going to be easier for you to bring in the MACD if you use Mozilla as your default internet browser. Okay, so how do we do that is help, code base. MetaTrader 5 and 4 is the same. So code base, I'm going to go here where it says search, type in the name Snowy, S-N-O-W-I-E, which is the author. Okay, click search. And the first one that pops up, click on it. You're going to see one that says MACD, FX Bay. You click on it. You click the button that says save file. As soon as you save it, it's going to pop in here. Right up there. Open it up. There's the file. Click on it. Right click. You'll see number 18. I've done it now 18 times. Click on it. Click copy. I don't need this anymore, and I don't need these windows anymore. I'm going to go over to my software now. File. Open data folder. Double click on the MetaTrader, double click on indicators, wait a bit, right click on the white area, paste it in, and you'll see number 18 right here. Now that I've done that, I don't need this window, shut down your software and relaunch the software. And it'll import it automatically. Waiting for it to come up. So there's the MetaTrader now. Oops. Sorry about that. So I'm going to open this one up here. And now it's just doing an update. It's just updating. It's just doing some updates. It'll take about a minute. Okay, once you've launched it, it'll bring it back like this. I'm going to open this window, insert, indicators, custom, and you'll see MACD number 18 right here. Click on it, click OK, there's my MACD. So now I have all my indicators up here. I'm going to right click, template, save my template. I'm going to name it LTT, which is already there. Click save. And now that I've done that, I'm going to go and right click on all the other charts that are there. Click my LTT, template, and file, tile windows. And notice I've got US Canadian, I've got Australian US, Euro US, and Euro Japanese yen. If you don't have those and you can get rid of all of this stuff, it doesn't really matter. You have one. Right? You have this one. You already have your template saved. You can go File, New Chart, and you can bring it in, Australia, US. File, New Chart, Euro, Japanese yen. File, New Chart, US, Canadian. File, New Chart. I'll bring in my oil. File, New Chart. I can bring in my gold. File, New Chart. I can bring in my indexes. Now, obviously, don't bring in too many products because then you're going to get overwhelmed with too many products. Then I go Windows, tile Windows, and I got 8 products here. Right click, template, LTT, right click, template, LTT, right click, template. And I can do this on all these charts. And I can now bring in the template that I have as the one that I saved for my workspace. Now I'm going to go to 5-minute charts because when you're trading, you're using small time frames. So each one of these will be 5 minutes. But don't forget, when you're taking trades, you want to take trades in the direction of the bigger time frame, which is your 60-minute chart. So always take a glance at your bigger time frame to kind of see what everything is telling you as to the direction that you should participate with if you're going to be using your smaller time frame. So for example, I'm looking at crude oil, for instance. On my 5-minute chart, crude oil is saying we're going down. Everything kind of lining down. I'll take a look at my bigger time frame. My bigger time frame, if I magnify, you'll actually see moving averages are down, RSI's down, my MACD's down. It tells me that, hey, I can be safe. I'm safe enough to take a trade on my smaller time frame based on my direction of the bigger time frame. So I've got everything lining up on the downside. I want an entry point that says a break of a previous valley equals my entry. So I'm going to put a line right here. And if I can break down below this little valley, right in here, that little V, you can see that little distinct valley. If I can break through here, that would be an entry point. So don't rely strictly on your mechanical. Rely on the overall picture that you're looking at. If you see a pattern, then use your patterns. But if you're going to use only your mechanical, make sure you have an entry point of a break of a previous valley to be able to take a trade. Once I decide what I'm going to take the trade, I'm going to bring this little button down. Let's say I wanted to trade a standard contract, 1.00, which on oil is $1,000 a barrel, $1,000 a point. I click the sell button. So there's my entry point. I've now sold one standard position. I want to put in a stop order. Well, notice the spread between the buy and the sell. It's 5 cents. It means that my cost right now is $50 on this trade because of the standard contract. You can see minus $50. I'm minus $60 right now on that trade because of the spread between the buying and the selling price. Okay, between that buy and sell. Once you execute a trade from this box, it's a one-click order. You click on it, you buy. You click on it, you sell. But once you execute a trade, you cannot close the trade from here because this is also a hedge software. Okay, so this is called a hedge software. So you can only execute and initiate a trade from this box. You close the trade by right-clicking on this order from here, or you can close the trade by clicking the X button right here. Okay, that's the only way you can close that trade. Right-click on your perforated line where you executed the trade, or click on the X button right here. Let's say I have an order that I want to take profit when it comes down here. I can right-click on my order, hold the right click button down, drag it down, and I can put a take profit order right here because I'm a seller right now. And if it hits that line, I can make 120 bucks. By the same token, I want to put a stop order. My stop order has to sit above a previous peak. There's my previous peak. But the distance above should equal the difference between the bid and ask. So at least this difference should be above that previous peak. So my execution right now, the stop order, if I bring that little cursor, says 53.20. I should put my stop order at 53.25. So I'm going to go like this, bring my stop order just around this price here. So now I know what my risk is. My risk on this trade, if I bring my arrow there, it says 140 bucks. My potential profit 120, and this is called a OCO order. I've linked my execution. There's the entry point with a stop loss and a take profit order. Whichever one gets filled will automatically close the entire position. Now remember, I sold. So if the buy button hits this order or the buy button hits this order, it closes my trade, which is the green box. Remember, I sold with the black, you buy back with the green. Okay, let's do another example. Okay, let's take the Euro US. Euro US right now looks like it's trying to break higher on my 5-minute chart. Quick glance at my 1-hour chart. On my 1-hour chart, everything's still pointing up, except for the MACD. Everything else slightly bullish. So let's just ignore the MACD for a moment. Take my time frame down to a 5-minute chart. I want to be a buyer. So I want to buy as the price is breaking up. I need to buy off the break of a previous peak. So there's my previous little resistance area. I want to buy only when it breaks above here as the prices start crossing over. Okay, I'm not going to have time to wait for that, but execute my trade. I want to do a standard position, 1.00. Click the buy button. I execute my trade. Once I execute the trade, one click, I cannot close it from here. I'm going to go to my order. Left click, hold, and drag down is my stop loss because I'm a buyer right now. Left click, hold, and go up is my take profit order. You can see both of those orders sitting right here. That's called an OCO order, where you have both orders in at the same time. So whichever one gets filled, the other one will automatically get canceled. Let's say that I wanted to hold this trade throughout the night because I think that oil is going to keep going down. I don't have to put a take profit order. I can cancel my take profit order. I can keep my stop loss order, and I can change this into a trailing stop by right-clicking, trailing stop, customize. Now, I want to put, let's say, a 50-cent stop. All I have to do is put 50 cents right here because it's the last 2 decimal points. I'm putting 50 cents, and I can click OK. But let's say I wanted to do a stop loss, a trailing stop on my Euro US. Let's get rid of the take profit order. And I want to put a trailing stop order here. And I want to put, let's say, a 20 pip stop. I could put 20, but I have an extra decimal point. Remember, that's a fraction. 20 pips is from the second last forward. I need to add another 0 to make it 20 pips in the currency market. So just remember that. Currencies, on average trade, you're getting the extra decimal point. So if you want to put a 20 pip stop, it's 200. Okay, and now you have 2 trailing stop orders. If I bring this further away, just to kind of show you what happens, notice it's yellow. But when you get within 10 pips of getting stopped out, it's going to turn red. Okay? Same thing with oil. If my stop order was way up here, it would be yellow because it's away more than 10 cents. But if I get close by 10 cents, this will start changing its color. It's almost like a warning sign. You're within 10 ticks of getting stopped out. 10 cents on here or 10 pips on your currencies. But right now I've got 2 trailing stop orders going. And I can now close my computer, and I don't have to worry about managing these trades. They're going to manage themselves because right now I'm not trading during times when markets are closed. I'm trading now that markets are open, and they're going to be open all through the night. Okay, that's a good question, Louis. We are going to introduce a technical analysis recap in May's tutorials. We're going to actually put in technical analysis as one of our tutorials just to make sure that we recap all the technicals, okay, so everybody understands how to use them properly. But for now, this is how you use your MetaTrader, and I've kind of reviewed on your Forex and CFDs. So find a broker you like, you want to deal with. If you're going to open up a small account, go to our website and go to AvaTrade through our website. If you're opening up a large account, you can go directly to Awanda or directly to Gain or Forex.com or CMC Markets if you'd like, and open up a larger account. It'll help you. A large account, you don't need a lot of leveraging. Small accounts is where leveraging is important. So on that note, you want to create a log for yourself. You can pick your chart and you can say, okay, I want to create a log. Well, everything is right here. All your text notes are right here. You can write text. You can draw arrows. You can put all sorts of stuff on your charts. Print off the chart so that you can put it in your file folder and review the winners and losers as you go forward. You can see here that I've almost covered the spread on the oil trade. I'm still pretty much, I'm 3 ticks away from covering the oil spread and a few ticks away from covering the euro spread. The only commission cost that you incur when you're trading with AVA is the spread between the buy and the sell button on all your products. Some companies in Canada will charge you a commission rate. Some companies will charge you the spread and a commission rate. So it all depends on which company you're dealing with. Okay, so just be aware of their conditions, and this way you know exactly what every company that you deal with is going to be charging you. Okay, so on that note, I think I've covered everything. You guys can keep an eye on these trades at home. I've got a short position on oil and I've got a long position on Euro US. So if you want to kind of keep an eye on these at home, you can sort of see where I entered the trades as well. And if you're dealing with your demo account, even better. Okay, that's a good question, Kamal. Right down here on the terminal, right in here says your account value, right here. Out of this money here, it tells you how much you're using right now to secure those 2 positions. That's the margin requirement for the 2 positions that I did, oil and euro. That's how much they're tying up from the account. Free margin means that's what you have minus the margin requirement. That's your the balance of the capital that you have available. Okay? Hope that answers your question. Down in here, you have your trade button, account history, all the trades that maybe you took, plus and minuses. You have your news reports, some news that come in right here. I use Forex Factory. There's a whole bunch of other stuff in here that I don't use because they also sell products here. Signals, you can buy signal software, robotic software. You know, they tell you how much they charge for it. I'm not interested. Market, they have a market where you can buy books and all sorts of other stuff. Again, not interested in any of this stuff. So I don't really use any of that stuff there. Alerts, you can create alerts for yourself just by, you know, whatever product you're looking at, you can create an alert that'll start beeping on your computer. So, you know, these buttons here, I don't use any of them except for my trade button. Sometimes I might use the alert and just looking at the account just to see what trades went in. So that's basically an overview of the software. Start fooling around with it, learn how to use it properly. And we do have a hands-on week that you can spend with us. We have the course coming up at the end of April, April 28, 29, 30 at Humber. If you want to repeat it again, you're more than welcome to do so. Send an email to Tundi so she's aware of you coming down. There is no charge. You're a lifetime member. I highly suggest you repeat the program as often as it takes until you understand it. This recording will be available tomorrow morning, and you can be able to review this as well. And we have the hands-on week again, like I said, coming up May 8th to 12. If you want to reserve a spot, 9:30 a.m. to 12 noon. It's also recorded for you. So on that note, I'm going to wrap it up here. I don't see any more questions coming in. We'll see everybody on our next tutorial, which is this Wednesday for portfolio option strategies. The following Wednesday is pizza night. Try to make it down to the office. And then the following weekend is our course at Humber College. If you have anyone that you want to refer to our program, we do pay out a $400 referral fee for anybody that registers and becomes a lifetime member because of you. We have 2 seminars coming up. We have one tomorrow night, 7 p.m. to 9 p.m. at our office, and we have one on Thursday, this Thursday coming, 7:30 to 9:30 at Humber. If you have anyone interested in our program, please refer them over to our website, learn-to-trade.com. so they can register for the free workshop, and make sure they put your name in the button that says how'd they hear about you. So go to learn-to-trade.com, fill in the free sign-up form for the workshop they want to attend tomorrow or Thursday. Make sure they put your name in here, and if they do become Learn to Trade members, we pay out a $400 referral fee to our members. It's a great way over time to be able to refer enough people, providing you're satisfied, providing you found value in the program. I wouldn't want you to refer anyone unless you're happy. And this way, we show you our thanks by giving you $400. 6 members over a couple of years is not hard to refer. Basically gives you your money back for what you paid for your own membership fees. Also, I wanted to bring you over to one more thing that I've been trying to get some reviews going. So if you go to google.ca, type in under google.ca, sorry about this, google.ca, right in here in the search button, type in learn-to-trade.com. It'll bring you over to our homepage right here. You click on it. Oh, sorry about that. I think you type in just Learn to Trade Toronto. Sorry about that. Learn to Trade Toronto with the spaces, all the spaces, just like this. Review. That's what you need to type in. Learn to Trade Toronto review. You're going to see on the right side here. What did I just do? Learn to Trade Toronto. You'll see on the right side, you'll see a button that says our link here that says review. If you have a Gmail account and you want to, if you'd like to put a review for us, just type in here, write a review. It'll ask you to sign into your Gmail account. You sign in and then you post your review. It would be greatly appreciated if we can get more reviews from our members. Hopefully you're satisfied enough to give us a 5-star rating. So far we're at 5 stars, which is really good. And we would appreciate it as well. So that'd be great if you do have a Gmail account, if you can just follow that process. So you go type in Learn to Trade Toronto review, separate words. And once you come to this page, just click the button that says review. Write a review, log into your Gmail account, and go ahead and do that. We'd really appreciate it. So on that note, thanks for joining me here tonight for the Forex tutorial and CFDs. And if you do have someone that you want to refer to our program, send them to our website, have them register for one of the upcoming workshops. And we do have the hands-on week, like I said, coming up in May, 8 to 12, and the weekend course, April 28, 29, 30. Good night, everyone. Thanks for joining me. We will see everybody on the next tutorial, this Wednesday for portfolio options, and next Wednesday for pizza night, and then the course weekend. Bye for now.